If I had to start investing from scratch, these are 5 mistakes I would never make again. And if I would have done these things when I started investing, my portfolio would be worth 2 to 3 times what it's worth today. If you've never seen me before, welcome to my channel. I'm Ryan. I've been investing in the stock market for over 16 years now, and I've made hundreds of thousands of pounds in profit. So without further ado, these are the 5 mistakes I made early on that I wouldn't make if I was to start investing again. And number one, and probably the biggest one, is investing blindly into stocks that you have no knowledge of. These are stocks that you don't understand. These might be things that you might have seen on the internet. These might be stocks that your friends are getting into. These might be stocks that look really good on paper, but you haven't done any research into them. Some of these stocks might be meme stocks, and we saw some examples of these in 2025. 2 big ones were Open Door and Beyond Meat. Now, I actually invested in Beyond Meat. I put £5,000 in, and I lost £3,200. So I only walked away with £1,800 off of my £5,000 investment. And the reason why I invested in Beyond Meat was because I succumbed to FOMO. So yes, even after being invested in the stock market for 16 years, I still fall victim to FOMO. So one of the big takeaways from me is only invest in stocks that you understand. Don't invest in meme coins that aren't making any money, that are driven up by hype. Yes, we all get shiny object syndrome. We want to get into these stocks because they look good, because our friends are in them, because you see screenshots of people making money from them. But just because they're making money from it doesn't mean that it's a good stock. And often when you get into some of these positions, you are the exit liquidity for the people who got in early. Another stock you shouldn't invest into is a company that you know nothing about. So one of the big things that I'm a massive advocate for is knowing how to invest in companies and understanding the companies that you're investing into. Too many people put too much money into companies that they know nothing about. Before I invest in a company, there's a key set of things that I walk through to make sure that the company fits my filters and my standard of investing. And one of those main things is the company makes money or has the ability to make money in the future. A lot of people I see who go wrong in the stock market invest in stocks that they know nothing about, into companies that aren't actually making money and are literally walking red flags. Mistake number 2 is starting your investing journey without fully understanding portfolio and risk allocation. Now, too many people will lump 100% of their money into stocks that are super risky, whilst overlooking stocks that are historically safe. So something I do in my own portfolio is I allocate 80% of my capital into blue chip stocks. These are stocks that have stood the test of time, that have been around for donkey's years. These are stocks like Nvidia, Apple, Amazon, and Google. And these are basically the foundation and blueprint of my entire portfolio. So I put 80% of my money into that. And then I put 20% of my money into speculative stocks. These are stocks that are a little bit more high risk, high reward. These are stocks that aren't guaranteed. A lot of them are early stage companies. They are very, very high risk, but they can yield aggressive returns. And I had 2 big winners in my own portfolio last year, and that was AST Space Mobile and Rocket Lab. Both companies I'm up hundreds and thousands of percent on. And what I normally find in the stock market is that people either play it really, really safe and they invest in companies that are great safe havens but don't actually yield that much return. A lot of ETFs fall into this category, or they invest in companies that are entirely 100% risk and they end up losing all their money. What you need to do instead is you need to find a balance in your portfolio between the two. You don't want to play it too safe where you don't actually get a return on your money, you don't end up making any money. But at the same time, you don't want to play it too risky where you risk all of your money and you lose everything and then you're back at square one, minus the money. So the 80-20 ratio works for me. 80% into blue chip stocks, 20% into speculative stocks. That is just personally what works for me. I'm not saying that would work for you, but you need to find your ratio and your correct strategy when it comes to investing in the stock market. Stop looking at what other people are doing and trying to copy them. You need to find a strategy and a system that works for you. Some people will incorporate ETFs into this or index funds. I personally don't invest into ETFs or index funds. I find the growth in them way too slow. But if you want a diversified portfolio and you want to take a little bit more risk off the table, you can start to incorporate ETFs into your strategy as well. The third mistake I fell victim to when I started my journey was trying to time the market. Now, I see this a lot and people always ask me, why are you buying at a certain point? Why don't you wait until the market crashes so you can get a more favorable price? And my counter argument to this is always the fact that no one knows what's going to happen in the stock market. Next week, we could see stocks rally 10, 20, 30%, or Trump could come out and say something that crashes the stock market. No one knows what's going to happen. So you asking me why I don't wait for a stock market crash before I buy more positions is complete nonsense, because no one knows what's going to happen in the stock market. And my thought process is, if I see a company that I like, I've got strong conviction on them, and I want to start a position, I have a buy zone in my head. And as soon as the stock enters that buy zone, I buy the stock and I hold it for years and years and years. I'm a long-term investor. I don't try and time the market. I don't try and price things in. I just buy good companies that I have conviction in, that I've done research on, and I hold them for a long time. And I've always found that the shorter your time frame in the stock market, the more risk you're taking on. And that is why people do day trading and they don't do very well from it. That is why people start swing trading. They try and make money in the stock market and it doesn't go their way. The shorter your time frames, the harder it's going to be for you to make money, because in the short term, no one really knows what's going to happen in the stock market. And a lot of gains that you see in the stock market from investors like me and many others come from holding stocks for a long time, investing for a long period of time. That is how I've amassed hundreds of thousands of pounds in profit in the stock market. It hasn't been through swing trading. It hasn't been through day trading. It's been through holding companies that I have massive conviction on over the long term. Holding Nvidia for 4 years, holding Apple for almost 16 years. And a saying that I always come back to when I'm asked about timing the market, time horizon, and a saying I always come back to when I'm asked about time horizon, timing the market, spending time in the market, etc., is the fact that time in the market is more important than trying to time the market. I can tell you countless number of stories of people who told me that Trump's Liberation Day tariffs were going to crash the stock market to zero, and then they were going to buy when Nvidia was $10, or Apple was $5, or Google was $20, and that simply just didn't happen. Now, those same people had the opportunity to get into these stocks when they were down massively off the back of those Trump tariffs. But now look at the stocks. They've all recovered, plus they've gone on to make even more gains. And those people that said they were going to crash to silly single-digit figures never invested in the first place, and they missed out on hundreds of % of gains. So that's a prime reason why I don't try and time the market. I just get into good positions and I hold them for ages. Mistake number 4 is one that I succumbed to when I first started investing, and that is to only invest money that you can afford to lose, and only invest money that you know you're not going to need to touch for at least a number of years, or however long you're looking to hold that investment for. This is really important because a lot of people are investing money into the stock market that they know they can't afford to lose. And when you invest money that you can't afford to lose, you'll find yourself panic selling, and we'll talk about that a little bit later on in the video. Now, my strategy when it comes to investing in the stock market is that anything I buy, I say to myself, I'm going to hold for at least 5 years. So before I invest that money, I make sure, number one, I'm not going to need that money for at least 5 years. So if I need that money to buy a house or I need that money to buy a car, I won't put it in the stock market because I don't want to have to panic sell when I need to use that money. And that's really important. So if you're saving for a house deposit right now, don't put your money in the stock market, even if it's in an ETF and you think, hey, I'm going to get 5 to 7% every single year. It's fine. I want to grow it slowly whilst we save for a house. No one knows what's going to happen. The year that you need to buy the house, the stock market could crash 50%. No one knows what's going to happen. And it's really important that you don't risk money in the stock market that you need to do something significant. Buying a house is a significant life event. Don't put that money that you need to buy the house into the stock market. It's not safe. And I think this principle is really, really important. Once you understand this and you can incorporate this into your investing strategy, you'll end up making smarter decisions and you'll become a better long-term investor. And mistake number 5, and probably the most important one, is to not panic sell when the stock market goes down. Now, we saw this recently this week with the stock market dipping slightly on concerns over AI and earnings, etc. And a lot of people would have panic sold. In fact, a lot of people DM me on my social media accounts asking me what I was going to do in the stock market and whether I was selling because they were worried about their position. A lot of them had only just started investing and it was the first time that they'd seen their portfolio red. Panic selling is one of the worst things that you can do. When in doubt, zoom out. And as someone who's been invested for 16 years, I understand and have been through many ups and downs in the stock market. Over the long term, the positions that I've invested in have gone up, but there's been many times where my portfolio has been red. Yes, I've been worried. Yes, there may have been times where I thought about selling, but my thing is always zoom out. Look at the history of the stock market. The stock market has always recovered from any major crash, any major dip, any correction. So I was not about to buy high and sell low. That isn't part of my strategy, and that's not what I think you should do either. Understand what you're investing into, understand the risks, and as you spend more time in the market, you eventually become immune to the ups and downs. In fact, nowadays, I love red days because it allows me to get into positions and buy stocks at a cheaper price, either lowering my average or starting a new position at a more favorable point. Panic selling is one of the worst things that you can do in the stock market, and it's something that I see so many beginners fall victim to. They get scared, they'd never invested in anything before, they've never put money into something that's gone down before, they don't really understand what they're doing, and then they panic sell, and they actually lose money. And that is how most people lose money in the stock market. It's through panic selling when the market declines. If you can control your emotions, have the right portfolio allocation, and the correct level of risk appetite when investing in the stock market, plus turn yourself into a long-term investor, you will stack the chips in your favor and you will have a very, very successful investing career. If you're completely new to investing, please subscribe to my channel because I'm dropping more videos like this, utilizing my 16 years experience in the stock market and helping beginners just like you. And if you want to get 16 years of investing experience condensed into one ebook, you need to download my Blueprint to Investing. The link's in the description, and I'll see you in the next video.